At every second of this video, there will be a child born in India. India is already home to over 1.4 billion people, speaking the fourth and the fifth most commonly spoken language in the world. It is also both the third largest economy and manufacturer in the world. And I'm sure you came across Bollywood at some point in your life, which is also the world's third largest film industry. But these are not the only reasons behind why India is considered to be the next big superpower. How India actually evolves over the next many decades and how that compares with other parts of emerging markets such as China is precisely why India gives a very strong fight for the top spot in an ideal investment portfolio. So let's begin and start with the whys. I have three simple yet big reasons behind why one can consider investing in the Indian stock market. First, let me share with you an open secret. There is a quick rule of thumb that people use to estimate what would be a future stock market return of a region or a country. And it is as simple as just adding two simple numbers. One is dividend yield and the second one is growth rate of stock prices. But when you use that formula at a country level, according to the Gordon rule, you can assume a steady state where growth rate of the market is equal to the growth rate of that country's GDP. So I hope by now you can see where I'm headed at, which is the GDP. GDP, or gross domestic product of a country, simply puts a number to the monetary value of how much that country is worth. And what's important for the stock market is how that value changes over time or grows over time, which we simply called as the GDP growth. As mentioned earlier, India is already the third largest economy in the world after you adjust for inflation to make them comparable to the other countries. But what's more exciting is how that GDP number has been growing over the last many years and how much that is expected to grow by over the coming years. According to the recent outlook by the IMF, they have estimated that India will be the fastest growing country this year, higher than China and miles above the United States. Although 2022 growth is generally higher for a lot of countries due to technical base effects, so maybe we should look at growth prospect for the year after. And yep, even in 2023, India is still projected to grow by as high as 7%. And by 2050, India is expected to become the second largest economy just behind China, overtaking the United States. There is a lot of reason behind why India's growth rate is expected to be quite remarkable. I don't want to turn this video into an economic lecture, but just to put it very simply, it has a lot to do with the country's population growth. Population growth is in fact an important element of economic growth or GDP. And even with population of 1.4 billion people, India is still growing that number. It's been growing faster than China, and so much so that India is expected to surpass China as the world's most populous country in just a few years' time. And an even more important aspect than just the headline population growth is the fact that India's population is still very young. Median age of someone in India is only 28 years. Compare that to the likes of UK, which is around 40 years. Basically, in the West, we have a huge problem of aging population. That's one of the reasons why countries find it in their own interest to open up their borders to migrants. So since population growth definitely matters for a country, especially working age population, India definitely tops that list. And the second reason is death of globalization as we know it. Globalization is a word people use to refer to growing interdependence of the world's economies through cross-border trades, investments, migration, and sharing of information. You can say that modern-day globalization started after World War II and reached this maximum or peak in 2008, just before the global financial crisis. The COVID pandemic may have already accelerated that trend of peaking globalization of traded goods. And now with everything that's already going on in Ukraine, it will only make the world less and less interdependent. That means if the primary good that you sell is either stuck here, or even here, it's probably time that you rethink your options closer to home. Basically, globalization as we know it is simply dying. And that's been happening due to the increased amount of geopolitical conflicts that's been going on in the world. Okay, so you must be thinking that is clearly bad for India. Yes, if you are only thinking about traded goods, but know if you can actually shift your mind to think about the service sector. Let's face it, every time you call a help desk, there's probably someone sitting in India picking up your call. They're providing you a service. Even outside of that, a lot of companies are still outsourcing their jobs to India. And one of the reasons why it has been relatively easy for companies to delegate that job to India is because they are in fact the world's second largest English-speaking country. Even half a century after Indian independence, English remains the language of higher education, national media, and corporate business. Not only that, India also made a huge progress in moving up in the World Bank's Ease of Doing Business ranking from 143 to 63. So India's service sector, which adds 54% to its economy and handles 56% of the world's business process outsourcing, is very well placed to continue on that growth. Number 3, India is heavily focused on its key strategic areas. There is currently a big push to privatize some of India's sectors, which will benefit from capital and investment, not just from the domestic market, but also international market as well. India is already the second largest mobile phone maker after China, but its smartphone export is still pretty tiny. And that is about to change. For example, Apple wants to shift 1/5 of its production capacity from China to India over the next 5 years. And all of these are happening while China becomes more and more internally focused. China enjoyed strong economic growth over the last many decades, and that is now expected to slow at a lower level. And not just China, the rest of the world also recognizes that change. So China is publicly now more focused on its quality of growth than the actual growth number. This video is not on China, so I won't dwell on that too much, but all that means is that all of those stuff are actually positive for India and Indian stock market. Now, having said all of those great things about why one can consider investing in India, let's not discount all the risks that we must also think about. And that too on top of the usual sets of risk that we must consider for any sort of investments that we make. Firstly, emerging market investing is a risk category on its own, and that's because these economies are most vulnerable to shocks. They are not as rich as the UK or the US to spend a huge amount during crisis. And different unique risk factors can trigger a sell-off in different countries within emerging markets. So we also have to consider geopolitical tension within the region as well. Secondly, these stock markets usually plummets by more than developed markets during a crisis situation. And that's because at times of crisis, people move their money to safe haven asset classes such as bonds and cash. So there is a big risk to capital flights by investing in those regions. Third, a rising interest rate in developed world gives it less meaning for people or investor to invest in emerging markets. So that also tends to negatively impact EM stock markets such as India. 4. Rising price of commodities such as crude oil is a risk for India. And that's because India is a net importer of crude oil. So if we have a price shock on oil, sending it higher, it will make it more expensive for India to pay for those oil for their own consumption. We have already seen strikingly high energy prices over the last couple of months, so it is definitely a risk that is worth bearing in mind. This brings me to the third and final part of the video, which is all about should you invest in Indian stock market right now? Well, this video was not made with the intention of going into the valuation numbers behind Indian stock market, but if we simply look at index such as Sensex or the Nifty index and their PE ratio, where high means expensive and low means cheap, we can see that PE ratios of this index remains relatively expensive versus its long-term average, which is roughly 20 times. However, it definitely came down or became cheaper compared to last year. Also, if you're thinking of the geopolitical conflict and the war that's going on in Ukraine right now, it is sending the oil prices higher. High oil prices reduces trade balance for India, which automatically reduces the economic growth for India, and low economic growth equals to lower stock market performance. So that is also another set of risks that you should bear in mind before thinking of investing in India right now. So here you go, some food for thought, but if you think it is going to be useful to go into detail on the valuation front on Indian stock market, do let me know in the comment section below and I will sure to make some videos on that. But that is all for today, and until next time, do look after yourself and your money.